joining us today. My name is Albrecht Weller. I'm president of Schwaben Capital Group. We're going to talk about the paradigm shift today, a 2021 update on COVID-19 and the impact of it on investments. Just a brief overview of what we're going to talk about, just a brief introduction to Schwaben Capital, who are our colleagues, the four pillars of the recovery, the vaccination, the race of the century, the US stats, do we reach herd immunity before 2022, the global stats, the COVID flows of money, the new package, corporate earnings, and equity sectors views, what our views are, and what we think are some of the ideas that he may take advantage of. Just a brief introduction to ourselves. I established Schwaben in 2010 with my partner Martin Häferle to offer a unique need for high net worth individuals and their wealth. The response to high commissions, high fees, and lack of advisor care. I used to run a family office, and at the time I noticed that a lot of the advisors did not provide the service that we were looking for. We're a fundamental space investor. We provide investment and wealth management. We offer corporate finance and advisory services to owners and their companies. We provide estate planning, executiveship, and insurance. And we also offer family office services that ranges across a broad range of services that affluent individual may require. The team, it's myself. I've been in the business for about 30 years. I've worked with some of the larger firms, also with boutique firms, and I ran family offices before. Martin Häferle, a successful entrepreneur, also a partner in the family enterprise that has offices in over 40 locations around the world. He provides us with help on high net worth estate and financial planning through his own experience with his family and family conflict resolution. Hamza bin Arif, he's joined us about a year ago, Vice President and Associate Portfolio Manager. He's worked in the Middle and the Far East. He's got a global work and educational background. The four pillars of recovery. The first one is vaccine. What is the global overview? The US inoculation stats and the global stats. The second pillar would be stimulus. The 1.9, the newest package, a $1.9 trillion stimulus package that's currently in the works. The sentiment, what are the money flows that have happened during COVID-19? How is it impacting bonds? And where is inflation at this point? And the last, but definitely not least, what are the earnings outlooks? There's a continuous upside surprises, and how is impact going to impact earnings? How is inflation going to impact earnings? The vaccine, the race of the century. Where do we stand at this point with vaccination? Canada has so far given 3.5 doses per 100 people. Just to give you an indication, most of the vaccines are double dose, so that would mean about 1.75% of the population has been vaccinated in some sort. The US is a lot further ahead. They're up to 5% of the population is fully vaccinated, with 17% of the population having received doses. The UK has actually gone a lot further. They have 25 doses, but not double vaccinated yet. So at this point, they've taken the stance that they will vaccinate most people initially with their first dose, and once everybody is vaccinated, they'll get the second dose. Saudi Arabia, Russia is a lot further behind, and China has 2.9 doses per 100 people. The total administered doses so far is 186 million. It's still a very small fraction, given the fact that the world has about a population of about 7.5 billion people. Herd immunity. Is the US going to reach herd immunity before 2022? Most Americans have now received at least one dose. More Americans have now received at least one dose and then have tested positive for the virus. So that's a breakthrough. 58 million doses have already been given. In the last week, on average, about 1.6 million doses were given per day. At that rate, it will take about 9 months to cover about 75% of the population. The UK and the US is currently on a path to reach herd immunity by the third quarter of 2021. In Germany and France, they'll likely reach it in the first quarter of 22, Japan, first half of 22, and India, which is further behind, likely because they have large population, they will likely not reach herd immunity until 2023. The global stats, the vaccination rate at this point is about 6.5 million doses per day on average. This would take about 5 years to cover about 75% of the population. We expect that the vaccination process will accelerate as more countries develop the infrastructure and develop their vaccination programs. So far, there's currently 7 vaccines available in over 82 countries. The sentiment, what I should be asking at this point, what do people feel the stock market going to be in the next 12 months? Are you going to expect the market to go higher? Are you going to expect the market to stay the same? Or will we be at a lower level 12 months from now? If you'd kindly click on your votes and then hit the submit button. And I'll give everyone a few minutes in order for us to have the entire poll completed. So far, we have about 12 votes, 14. Yeah, so we're starting to get more votes in. I'll give everybody another minute or two to complete the polling, and then I'll show everybody else. We're getting closer. I'm gonna give everybody another 30 seconds, and then I'm gonna show everybody what the sentiment is of all the participants here. Okay, I think I'm gonna go. About almost half the people think that we're gonna be higher. About a quarter are gonna think we're the same, and a bit more than a quarter think that we're below where we are at this point. Well, we seem to be in the sentiment that we'll likely have higher stock markets. And one of the reasons is that really being that we think we've seen a lot of pain, and we've seen changes in the economy, and there will be a paradigm shift in certain aspects, at least over the next 12 months. So what does that really look like? The great COVID inflow. What is the great COVID inflow? It's really 25% of the 2020 stock market activity was created by individual investors, which is 2.5 times of what we had in 2019, which was only 10%. Companies like the Robinhood investors and Reddit and all that has created a certain amount of speculation and gamification of stocks. Elizabeth Warren recently said that she felt the stock market was really nothing else than a casino. Not really the case. They've done an academic study, and they found that about 10 to 15% of the stocks currently have a certain amount of excessive risk, and there's a certain amount of gamification going on. But the remaining 85% are still very solid stocks and do very well. And I think it's up to everyone to make sure that what they invest or what they're being told to invest, that they're solid stocks. Even in the longest bull bull market that we've seen in the last 20 years, which lasted from 2009 to last March, there was not a significant investor interest. During COVID-19, we got a lot more individual investor interest. I think it's because we've seen a lot of volatility, and a lot of people were shocked by the downturn that we've seen last year that was about 37% from top to bottom. Lower yields have forced investors to invest more in stocks. Yes, there is a greater risk, but most individual investors feel that if they're only getting 0.25% on their money, they would rather invest in stocks where they get maybe 3, 4, 5% on dividend deals. In the last 10 years, out of $3 trillion of investor flows, 94% went into the bond market. This is very drastic. This will likely reverse. The $3 trillion could reroute from bonds into equities. A further $3 trillion of savings over the next 10 years could create a $6 trillion inflow into the stock market. Larger inflows from more money market funds to global stocks is about $44.5 billion after Pfizer's breakthrough of the COVID vaccine in November 2020 than we've seen in the last 2 decades on a weekly inflow. The bonds, how have they really changed? How has the bond environment changed over the last 20, 30, 40 years? When I first immigrated to Canada in 1980, 2 years later, we were faced with 16, 17% interest rates. Even government bonds yielded well over 10, 12%. So over the past 30 years, the average investment grade bond yield was 7.5%. Now we're only getting 7.5% on CCC rated bonds, which is really considered not investment grade. In other words, in the investment industry, it's considered junk bonds. Higher risk has to be taken these days to get decent bond yields. There are certainly still bonds out there that may be rated lower, that have a reasonable quality. However, the yields are just not there anymore. So a lot of people will now invest in the stock market. This has driven the stock market to an extremely high valuation. We're currently touching about 36 times a P ratio of about 36 times. What that really means, we're only getting about 3% earnings yield on the stocks that we're investing in, which is very high, but it's driven by the low interest rates and low bond yields that we're currently getting. Since 2018, there's been an outflow in equities of $300 billion, while the inflow was in the neighborhood of $1 trillion into bonds. That was obviously caused by the correction that we've seen last year. So with the bond flow having seen a $1 trillion inflow, where is really the bubble? Is it in stocks or is it in bonds? We dare to say that it's in bonds. Currently, households in the US control $100 trillion in net worth. We assume that $3 trillion from bonds and $3 trillion of new savings will flow into investments. We could expect about a $6 trillion inflow in the next 10 years. It may be maybe lower than this. Obviously, a lot of individual investors will likely gravitate to more towards equities, whereas institutional investors are still required to hold certain assets in fixed income in order to offer their asset liability matching. The great COVID inflation. In January 2021, the Eurozone prices rose the fastest in the last 5 years. Container ship space has increased by 180% over the past year. Inflation results in stocks generating better returns than bonds. Because bonds are fixed coupons, they don't move. As inflation goes up. However, companies can increase their dividends. Inflation is also a benefit to corporate earnings. As inflation takes place, companies during times of inflation will raise their prices and will have more pricing power. High inflation in the US has generated only 30% real rate of returns during high inflation times, whereas stocks generated real returns 55% of the times. On an average in the US bonds have actually lost about 2.8% in real returns, versus stocks have gained about 2.5%. Stocks offer better opportunities than bonds during times of inflation is really what our conclusion is here. The stimulus, where do we sit with the stimulus at this point? The US new package that Biden has proposed is a $1.9 trillion economic relief package. It extends unemployment benefits. There's hundreds of billions of dollars going into schools and local government, and it will strengthen vaccine delivery in healthcare, which should definitely offer significant recovery efforts to the economy. The third stimulus check proposal is about $1,400 for individuals making up to $75,000, for $150,000 in income per couples. There will also be more child tax credits. Children under 6 will get, families with children under 6 will get $3,600 per child and $3,000 per child aged between 6 and 17. Federal unemployment benefits extended through the end of August will benefit amounts raised between $300 and $400. There's another provision, a minimum wage provision that Biden has proposed, which is $15 an hour. This would cost 1.4 million jobs, however, would lift 900,000 people out of poverty. Biden thinks, however, this is a long shot, and it may be a bit too far to the left. Earnings continue surprising on the upside. Revenues have really not beaten expectations by very much, but only by about 2.5%. However, earnings have been much, much stronger than people have expected. That doesn't mean that earnings were really that strong, even though a number of companies have really benefited. But it was likely also because of the lower expectations from a lot of people, what earnings would really do. In the second quarter of 2020, earnings surprised their expectations by about 23%. In the third quarter, it was 19%, and now it's 17%. One of the main reasons in my mind is that a lot of analysts and economists have realized that earnings are doing a lot better than what they expect, but we're still outperforming expectations on the earning releases. So where do we go from here? What are the sectors should we be looking at? And those sectors are not sequentially organized. There are just 5 sectors that we think will do well. Each individual security should still be considered based on evaluation and based on the fundamentals. And that's where you can either talk to us or you can talk to your own advisors. Healthcare, it brought attention, and attention brought money, and it brings innovation. Healthcare innovation improved significantly through AI because of COVID-19. AI-based strategies cost for drugs and vaccines have been drastically reduced. Also, the healthcare infrastructure movement due to COVID-19 will outlast the pandemic for many years. Some of the names that we would recommend at this point may be AbbVie, United Health, Biogen, or CVS Healthcare. Environmental, social, and governance, ESG as they call it, is not a sector, but more of a theme. It's really, in Europe, about $6.5 billion were flowing into environmental, social, and government funds and stocks last year, versus outflow of $15.5 billion in funds in Europe. The green party is becoming stronger in Germany and in France. In the UK, the environmental aspect is the third most important issue for voters. And countries are adopting zero carbon targets. Biden campaigned for zero carbon emission by 2050. Some of the countries that have already adopted that is Sweden, UK, France, Denmark, New Zealand, Hungary, Japan, South Korea, and even China has joined that campaign. So there's legislation in all those countries that have already made sure that that target will most likely be reached. Technology, another area that we feel has a lot of potential. Technology will continue to thrive. However, one has to be selective. The hardware area has become very frothy, whereas the software area still has a lot more potential. The software area is also a lot more scalable. So what we want to emphasize on that is the importance of stock selection. The slowdown in demand is likely going to happen as we get through the pandemic. There will be tougher regulations under the Biden administration. We already see that with Facebook and a number of other companies. And there will be increased competition. It hasn't always been competitive as it is right now. Some of the companies that we see in that will likely do well are AI-driven companies. Salesforce, which is a CRM, customer relationship management program. Microsoft will likely do well, and there's a lot of other companies that will do well. The next sector is really consumer discretionary. We feel there's value to be found. There's going to be pent-up demand because of higher savings and lower retail inventories. There's also about a $1.5 trillion excess savings in the US. Essential businesses have beat down non-essentials, the consumer discretionaries. Once the economy is fully open up again, we expect that people will go out and will do a lot of shopping that they haven't been able to do for the last year. There will be a reversal from consumers going out to shopping. Some of the names that we can see in there is Nike, Home Depot, Tapestry, which is women's accessories, and a number of other companies. Again, we'd be more than happy to talk to you about those. And the last, but obviously not least, is air freight and logistics. It's a necessary service. We feel there's remote, and because of remote activities by a lot of employees, there's more deliveries required and more logistics is required. Also, there's more cargo space and more cargo dedicated freighters rather than to passenger aircraft that carried cargo in their bellies. So that offers pricing power, and we believe that they will continue. Thank you. As at the end is our contact information. Myself, I can be reached at the email address or at 416-477-7216, or you can reach Hamza at his email address or at 416-477-7217. We'd like to thank you very much for attending our webinar, and hopefully we'll see you soon again. In the next month or two, we'll likely have a webinar on cryptocurrencies. So you may want to keep your eyes out when our next invitation will go out. Thank you so much. Have a good day and a good week.